August 10th, 2025. Welcome, everybody, to the Women in Money podcast, and everybody smart enough to listen. Suze O here. Today is Suze's School. And yes, this is the third part, our very last part of what I want all of you to know about the big, beautiful bill. Now, listen to me. There are many parts of this bill that I hate. I hate so much I can't even tell you. But that's not what I'm going to focus on, because there's not a lot we can do about those things at this moment in time. What I am focusing on for these three parts are the things you can take advantage of that can save you money, to help you make more out of the money that you make. So just know that. So don't be out there and go writing all this negative stuff about, well, why isn't Suze talking about the health benefits that are going away or this and that? I get it, everybody. But you first have to be able to take advantage of the things that you can take advantage of and not waste money. So just get off of it and really, really listen to the first one, the second one, and this one when it comes to the things you need to know. Because all of these things that I'm talking about from the big, beautiful bill will save you money in many instances. So, are you ready to take out your Suze notebook? And by the way, yes, Miss Travis is back. She wanted to do this Suze School with me, and I said, you cannot. You cannot. I have one more part to get through, and then I'm not touching it again for a long time, okay? Did you all like stable coins? Did you learn anything? All right, no problem. Now listen to me, everybody. The things that I'm about to go through, believe it or not, the very last one may be the most important to many of you. So just make sure that you listen to this podcast all the way through. All right, everybody, let's start. The very first thing that I want you to know, and I think that is really great, by the way, is the child tax credit. And really, it is a lifeline for so many parents. I can't even tell you. So if you happen to be raising kids under age 17, I need you to listen up, okay? Right now, the child tax credit gives you up to $2,200 per child. Notice I said right now, and that's because it is in effect right now. And guess what? Even if you owe no tax, because there are many of you that don't owe any income tax at all, $1,700 of that $2,200, and that's per child, by the way, is refundable, meaning the IRS will send you a check. Now, I don't know, but for many women that I know who are single mothers, they have 3 kids, they were in an abusive relationship, they live for this. But the problem is they don't have any income tax write-offs, they're da-da-da-da. This is really, like I said, a lifeline. Now, what you have to know, but really it's not going to affect those of you who are reliant on it, is that this credit starts to phase out once your modified adjusted gross income hits $200,000 if you're single or head of household, $400,000 if you're married or jointly. Now, there is a catch. You must have a child who qualifies, and that means they are a U.S. citizen and they live with you more than half the year and is your dependent. So I am asking you to think about this and do not leave money on the table. That was number 1. Number 2, auto interest loans are now deductible for the car you actually drive. This isn't for business. This is for the car you actually drive. And in many circumstances, I have to tell you, this one is fabulous. You can now deduct up to $10,000 per year in interest on a personal auto loan, as long as, there's always a catch, isn't there? The car is assembled in the United States. The loan is in your name, and this car cannot be leased or a business vehicle This, again, everybody, is for your personal car, but you all know I don't want you to lease a car no matter what anyway. That's besides the point. And it's good through 2028. So if you're buying a car and financing it, please make sure you qualify. Just ask, does this car qualify or not? Number 3, this will not be for all of you, but it's a big one for many of you. Bonus depreciation. And this really is for small business owners. If you are self-employed or you own a small business, I'm telling you, this is your moment, because you can now write off 100% of the cost of qualified business property in the year you buy it, as long as it's January 19th, 2025 or later, which is when you acquired it. So you just need to know that, all right? So think computers, think office equipment, even a car, by the way, you use for work, because this bonus depreciation, listen to me, does not expire in 2028. Oh no, this one is now permanent. That means make more money of your money. That is more money in your pocket faster. But remember, personal assets don't qualify. This is for business. The next one, number 4, is what's known as a QBI deduction, qualified business income deduction. So again, this one is a game changer for many of you. Let's just say you earn money through a pass-through business like a sole proprietorship, an LLC, an S-corp, or even a partnership. You may be able to deduct up to 20% of your qualified business income. If you think that's not a lot, that's a lot. Now, the full deduction is available if your income is, let's just say, if you're a single, up to $197,300 of adjusted gross income, and it goes away, it phases down once you make over $247,300. If you're married, filing jointly, as long as your modified adjusted gross income is below $394,600, full 20% deduction. All right, everybody? And it phases out once you are making $494,600. So if you're above those limits, again, the deduction might phase out based on your business type and how much you pay yourself in wages. But I just have to tell you, this is huge for freelancers, for gig workers, for consultants, for small businesses. And guess what? This one also is extended through 2028. Just that simple. You know, it dawns on me as I just have done all these for you. Why do they allow you to do these things? Number 1, it saves you more money, right? What do you do with the money that you save? Most of you, if you're smart, you save it, you invest it, you take advantage of what's happening in the markets. But many of you will do what? You will go on vacation, you will spend it, you'll buy this, you'll buy that, you'll spend it. And when you do, what do? You stimulate the economy. Don't you find it's a little funny that many of these expire in 2028? You do know what happens in 2028, don't you? Yes, you do. We have a new president. So just something to think of. That's why I think they're doing all these things, because it really helps the economy look better. But if you're smart, you'll forget about the economy and you'll think about your own bottom line. All right, next one. And I have forgotten the number we're on, but it just doesn't matter. All right. Tax-free tips. Now listen, a lot of you are like, no, you should have to pay taxes on your tips. Whether you should or you shouldn't, you all need to be a little bit compassionate, because there are many people out there, many, that really, they work for tips. Whether they're hairdressers or waiters or whatever it may be, they are able to sustain their family because of tips. However, many of them haven't claimed tips because they didn't want to have to pay taxes on it, because if they did, they wouldn't have enough money to survive. But I was always sad about that, because if you didn't claim your tips, guess what else? Your Social Security later on isn't as much. So it catches up to you. So if you rely on tips for your income, I want you to listen up right now. This really is one of the biggest tax breaks you're going to ever see. But listen closely. I need you to keep really immaculate records and report every penny of tips. And you need to know the income limits. All right, again, starting this year, right here and right now, individuals can exclude up to $25,000 in tips from, now this is important what I'm about to say, from federal income tax every year. Not state income tax, federal income tax. And any tips over $25,000 in a single year are going to be taxable as normal. Now, again, I just said it, this is only true for federal income taxes, not state, unless you live in Illinois, Massachusetts, New York, New Jersey, North Carolina, Oregon, and Pennsylvania, because they all have bills currently under consideration to make it so you don't have to pay taxes on the state level. So keep checking, because if your state passes a bill, then guess what? It is going to be tax-free for both federal and state. However, remember, there are 9 U.S. states currently that have no personal income tax at all. So tip income is not taxed on the state level in those states, and you already know what states they are. Now, again, the annual limit is $25,000 per tax return per year, and that is the maximum that is tax-free. Notice I said per tax return, not per person. So if you're single, you file one tax return, there's a $25,000 exemption. But if you're married filing jointly, you also file one tax return, you still only get $25,000 of an exemption, not $50,000. And by the way, if you are married filing separately, oh, you are so out of luck, you don't get an exemption at all. So all of you really need to think why you file married filing separately. You really do. You don't get to do a Roth. You don't get to do a lot of things. Now, listen, most of you will get this $25,000 exemption, but you need to know that some of you work for tips, believe it or not, and you do make a lot of money. However, the single filers, the $25,000 starts to phase out once you are over $150,000 of modified adjusted gross income, or $300,000 if in fact you're married filing jointly. And the phase out gradually, meaning it's no longer there, is once you are making over $175,000 as a single, $350,000 married filing jointly. Then it's over. But let me just give you an idea of how it works, okay? Because listen, you may be married filing jointly, and maybe your spouse makes a whole lot more money than you do. However, you're working for tips, and what you're working for really gets your family to get by. All right. $25,000 deduction, remember? But it is reduced by $100 for every $1,000 over the limit. All right, so that's what you need to know. That's how it works. Now, one thing you all do have to remember is that even though it's federally and possibly state tax-free, that doesn't mean that they're not going to take out FICA, which Medicare taxes. They will still apply to all tip income, even the tax-free portion. However, I have to just tell you, because you might be worried about this does not affect eligibility, however, for the earned income tax credit or other credits. So, what's your takeaway here, everybody? Because this really is a gift. But remember, gifts, in my opinion, come with responsibility. Usually it's like writing a thank you letter not an email, to whoever gave you the gift, but that's besides the point. Number one, I want you to track your tips. I want you to report everything honestly. I want you to file your taxes carefully, and I want you to watch your income levels, because what good is a $25,000 break if you blow it by not filing again? This is only good through, what is that magic year? What is the magic year that things change? Possibly 2028. Next topic is overtime. Now, truthfully, a lot of you really ask to work overtime. You need to work overtime. So this really could seriously lower your tax bill if and only if you qualify. So first, let's get it straight. What is overtime? Overtime is not just working hard. It's not working weekends. It's not getting a bonus or holiday pay. No. Overtime means this. You are a W-2 employee. Got that? Who works more than 40 hours in a single work week, and your employer pays you time and a half. That's 1.5 times your regular hourly wage for those extra hours. So if you normally earn $20 an hour and you work 45 hours in 1 week, those extra 5 hours must be paid at $30 an hour. That's real, legal overtime, and only that qualifies for this deduction. Self-employed, guess what? You can't do this. Now, for the tax years 2025 through what? What's that magic deadline? 2028. You may be able to deduct your overtime pay from your federal income tax up to a limit, right? So again, if you are single, you can deduct up to $12,500 for overtime pay each year. If you are married filing jointly, the deduction is up to $25,000. This means if you made, let's just say, $10,000 in true overtime this year and you qualify, you probably won't have to pay federal income tax on that $10,000. Now, if you are single, your MAGI has to be under $150,000. Married filing jointly under $300,000. And again, it phases down till you hit $170,000 for singles, $340,000 MAGI if you're married filing jointly, then you don't qualify. And again, should I just reiterate? If you're married filing separately, you just don't qualify. Remember, the deduction is temporary. And just like tips, it's only good for 4 years. You know this money's available to you. The question becomes, how do you claim it? How do you get that deduction? All right. You claim the deduction on your federal tax return using Schedule 1 as an adjustment to income. So you're going to subtract your eligible overtime, whether it's $12,500 or $25,000, depending on your filing status, from your taxable income. But I need you to keep your pay stubs, your timesheets, and your W-2s to prove how much overtime you worked and how much you were paid. Your employer may even report your overtime separately on future W-2s to help you and the IRS track it. But just in case, you have to be responsible. So keep your pay stubs, your timesheets, your W-2s, all of it. Do you understand? Now, the overtime deduction only applies to federal income tax. It does not mean, again, that you don't pay Social Security tax, known as FICA, or Medicare tax on the amount of overtime reported. So yes, your full overtime pay is still subject to payroll taxes, even if you deduct the overtime from your 1040. The IRS still considers it wages for the purpose of Social Security and Medicare contributions. So your employer still has to withhold FICA from those earnings. And guess what? So do you. I don't want you to confuse what helps you on your tax return with what affects your paycheck. These deductions don't increase your take-home pay during this year. You will see the benefit when you file your tax return. Now, when you see that benefit, can you just take that money that it saved you and fund your Roth IRA, fund a retirement account, pay down your credit card debt, do something with it that makes sense? Now, last but not least, and this is the one I have to tell you, I saved the best for last. And you're going to say, really, Suze? You think this one's one of the best? And it is for many people. Are you ready? It is the new Trump accounts. All right, get up off the floor. All right. So if you have a kid, a grandkid, a nephew, a friend, anyone, I don't care who it is, who is 18 years of age or younger, there are two parts of this program that you need to understand. And I have to tell you, in my opinion, I think this is a great program. Sure, there are downfalls to it and things like that, and could it have been better? Absolutely. But it is what it is. And wishing it were something different doesn't help you. You need to understand what it is. So again, children born between January 1st, 2025 and December 31st, 2028, who are U.S. citizens with a Social Security number, got that? Will receive, did you hear that? Will receive an automatic one-time deposit of $1,000 from the Treasury. Now, the Treasury intends to begin July 2026. So, what you need to get, it doesn't matter when your kids are born, 2025, 2026, the Treasury is going to put that $1,000 in a Treasury account. So you have to stay tuned onto how they are actually going to do that. But that is what they are going to do. However, besides the $1,000 from the Treasury, you can contribute up to $5,000 per year into the Trump account for each child. Again, as long as they are under 18 years of age. Now, that's important to know because listen, children who are born before 2025, you may be saying, oh, are you telling me my kid doesn't matter? I had a kid last year, so I can't get any of this. The kid doesn't qualify for the government contribution of $1,000. However, they do qualify to allow you to contribute up to $5,000 per year into a Trump account. And this sum, this yearly $5,000 or whatever you want to put in, can come from parents, friends, grandparents. It just doesn't matter. Now remember, your kid has to have a Social Security number and be a U.S. citizen. All right. Let's say you can muster up $5,000 a year. You can say, you know what, everybody? Rather than giving my kids gifts and ever give $500 here, $100, whatever it may be. But let's say you were able to contribute $5,000 a year for 18 years, because once the kid is 18, you can no longer put any money in this account. That's $90,000 over 18 years. Even if your kid is just currently 14 years of age, you can still sock away a nice sum of money. So the question is, should you or shouldn't you? And it obviously depends on your situation, but let me just educate you just a little bit more about all the details and really why I like it. The first detail that I like, believe it or not, is no one, not you or your kid, because this will be in your kid's name, can take a penny out before your kid turns 18. Too often, you put money away, it's for your kid, and all of a sudden you end up taking it, using it for something else. No one can take a penny out before your kid turns 18. Second detail. After 18, till they reach 59 and a half, because this isn't like a retirement account where it has RMDs. They could leave this money in there for as long as they want. They never have to take out a penny. Then it goes down to their kids, whatever it may be. But now listen to me. They can leave it in there, but until they reach 59 and a half, they are allowed to take penalty-free withdrawals, meaning no 10% penalty, for 3 things: qualified education expenses, up to $10,000 towards a first-time home purchase, and seed funds for starting a small business. I don't know. I think that's kind of great. If they take out any money before the age of 59 and a half for anything but those 3 things, like I just mentioned, they will owe a 10% penalty on it. Obviously, once they turn 59 and a half, no longer is there a 10% penalty. And the third most important detail: any and all money withdrawn, no matter what it is for, the growth part of that money is taxed as ordinary income. Your contributions are not taxed. So any money that you withdraw, doesn't matter, after the age of 18, all withdrawals are all part growth and return of money, which is how they are taxed. Let me just give you an example, all right? Let's just say your kid is 18 and your child's Trump account is now worth $170,000, because one thing that you should know, this money will be invested in indexed funds or ETFs or whatever they're going to do, but the money during those years that it's in there is going to be invested. So let's say over 18 years, the average annual rate of those funds, let's just say we're 7%, an annual average rate. All right. So you put in $90,000. The account grows by 80. You now have $170,000 in there. What you would do is divide the 80,000, the growth of your money, by the 170,000 in this case that's in there, and that is 47%. Now let's just suppose they withdrew $20,000 for college expenses, so there's no 10% penalty. 47% of that $20,000 is only $9,400. That is the amount your kid would owe taxes on in their tax bracket. The remaining part of that $20,000 is $10,600. That is returned to you tax-free. Now, don't freak out here, because I can hear you now. Well, how will I know? How much is going to be growth? Who's going to keep track for me? The financial institution, the bank or broker managing the account, is going to track the basis for you. For example, the total contributions, and they will report the taxable portion of each withdrawal on the IRS Form 1099-R. So you and your child will use this form, just that simple, to file taxes, reporting the taxable income portion. So the next question is, well, what's better, a 529 or this? Because remember, a 529 plan, you can take the money out tax-free for education. But not all of your kids go to school. And then what do? You end up owing the 10% penalty on the growth and everything like that. If you are focused specifically on education, then exploring a 529 plan is likely smarter, especially because they offer tax-free distributions. And for qualified expenses, they may also offer state tax benefits. When would a Trump account be better? A Trump account might be better if your kid doesn't want to go to school, whatever. But here's the real bottom line. There's nothing preventing you from doing both. You may also want to do a Trump account and a Roth IRA separately. Because let's say your kid starts working as a teen or in college, then a custodial Roth might be the way to go as well. But you could do all of them. A 529, a Trump account, a Roth account, all of those things are important. So that, everybody, brings us to the end of this 3-part series on the advantages that are within the big, beautiful bill. So until Thursday, I don't have a clue what we're going to do, except I do know it's Ask KT and Susie Anything. So everybody, tune in and remember, make your money make more money. All right. Bye-bye.
We are strong.